Markets are melting, tariffs flying, treasury yield spiking, everyone's yelling a crash. But what if this isn't a collapse at all? What if this is the setup for the melt up? Today, we're going to be discussing the bond market panic. Is it a real or hype? We're going to be giving you the charts talking about China tariffs and the 84% tariff retaliation. Is this just a headline? We're going to be talking about the volatility, giving you the VIX chart, talking about credit and the liquidity check, and also going to be giving you what our picture, which path is this going to take? Is it going to be a volatility crush, or is the credit actually going to break? So before we get into this, viewers, make sure you hit that subscribe button and press that like button, and we're going to go for this. Now, Oz, crazy headlines happening, everywhere in the space. So first thing we're going to be talking about is the main breakdown. We're talking about the bond market panic. And is this actually real or hype? And I would like you, Oz, to give the viewers a recap of the 10-year and the 30-year spike.
Yeah, hi Duck, how's it going? Yeah, so the markets are crazy at the moment, don't get me wrong. We're in kind of I would say a headline economy at the moment where every headline is causing volatility. So, we had the tariffs and all that sort of stuff, but let's actually look at the charts and look at, the what we can say is the heartbeat of the economy. And truly, are we going to see a 2008 style crash, or, is this just a fake thing? So if we look at the treasury and we go to the 30-year treasury, right? So we had that 5% spike, and now it's cooled off a bit. The 10 years similarly went up to 4.5%, and now it's cooling down to 4.3%. Now, when you see the treasuries act like this, so it's so volatile. People are saying, yeah, maybe China's selling, or there's tariff panic. There's a lot of fears in the market at the moment, but for me, what the key factor would be was looking at the 2 year. So when I look at the 2 year, that's what the Fed is kind of looking at to see if there is actually a system breakdown. Is something breaking? Is there stress in the market? And when I look at the 2 year, or when I was looking at the 2 year earlier, it wasn't really showing much that there was a liquidity issue at all. It was just showing us that this is basically panic at the long end, at the 30 year, at the 10 year, but the short end, the 3 month and the 2 year, relatively flat. So for me, this was more like, I would say, long end panic, but nothing I would say in terms of the system, nothing breaking. If we look at the 3 month and the 2 year, quite flat, to be honest. So overblown panic in my repositioning. That's what's happening. Nothing's really going on behind the scenes. And another thing to look at was the SOFR, the basically the secured overnight funding rate. Nothing overboard. It's not going above the Fed funds rate. It's not above 4.5%, or it's not below 4%. So for me, it just blowing things wildly out of proportion in terms of the treasury market. And at the moment things are unwinding, and we just have to carry on looking at this. But yeah, it's just a lot of fear in the market. That's what I would say. A lot of fear at the moment, but nothing systematic is breaking down.
Okay, Oz, everybody's talking about 84% China tariff, but let's be honest, Oz, DXY really didn't blink about this, did it? I mean, is there really an economic damage, or is this just headline and noise?
The China virus, China.
Yeah, there you go.
Back to Trump, reminds me of COVID. But yeah, look, at the end of the day, America put the 100% tariff on, China retaliated 84%. People are going crazy. It's more, for me, this is more, no one wants to back down rather than actually anything systematic. And what we can say, how can we look at the charts? We look at the charts, is it telling us anything different? Is it telling us that things are actually breaking down? Let's look at the DXY, and that's something that's very important. Now, if we're seeing something break, you would want to see the DXY going vertical, starting to spike, starting to cause stress into the system. But the DXY is just it's relaxing. It's just flat. It's nothing. It's not even taking anything into consideration at the moment. So for me, again, with the DXY, it's still a spike. And another thing that's very important is copper. Copper is while this is happening, stress days I would like to call them, peak points. Copper showing demand. It's not saying that we're in crisis at the moment. Copper's up 2.6%. Yeah, it could be a fake out. We have to wait and see. But just initially, what I'm seeing is that with all these headlines and headlines making the news, the actual core of the system, DXY, why is it not spiking? Copper, why is it not falling off a cliff? So yeah, the markets are reacting. They're reacting to the narratives. You're getting headline news. You're getting every time someone comes up on Twitter and says something, you're going to get wild volatility spikes, and I'll explain that in a second. But is this structural damage? That's what we have to really, really think about. Is this hurting the economy at the core in terms of credit spreads, in terms of credit? Are we actually going into basically a 2008 style recession where things drop 40%, or it's basically a massive crash? At the moment, with credit, copper, DXY, it doesn't see, there's no signs of that happening. So for me, yeah, there's plenty of fear, don't get me wrong, but the crash at the moment, I'm not so sure. So yeah, Doc, with that, I wouldn't say things are gonna die in the next day or so.
Yeah, but it's interesting, Oz, because definitely one thing that we can see, and this is probably what's causing issues with anybody who's trading or anybody who's in the crypto space and generally in the whole finance space as well. There's definitely an issue of volatility. Volatility is up, but for our viewers' sake, this question is why is it? Why is this crazy volatility? And just looking at the VIX, 9 days is popping. VIX is elevated, skewing at minus 6.5%. But does that actually scream a systematic risk to you, Oz, for the benefit of viewers, or are we just looking at another fair trade that smart money is already positioned around?
You see, now with the VIX, it's very important to look at this, right? So the VIX will just tell us the volatility, the SOFR, the SOFR, the rate, the HYG, and other things will tell us if the system is breaking. So for me, you have to take things step by step. You can't. It's not just as easy as looking at one chart and saying, okay, things are not breaking. Right now, what I will say with the VIX, and we just go to the VIX. This is the VIX. It's at 52. It's highly elevated, right? The VIX is one of the highest points. You could say, the last time it was here was back in in March. You could say 2020 was the COVID crash, and before that, financial crisis. So it's high. Don't get me wrong. The VIX is very, very high. But what we can say with that is, with the VIX, I look at so many things in terms of the VIX. We look at the VIX 9-day. That's the short-term fear. So basically, the short term, which is 9 days away, is saying we are in so much fear right now that the world is going to end. That's what the 9-day is saying to me right now. The VIX 9-day. Think about it. It's at the VIX 9-day is at 67.63. COVID or not COVID? COVID. Around COVID was 85. That's understandable. And then you go back. So the 9-day is saying we're dead. The 3-month is, you can say, almost half or just a bit more than half lower. So the 3-month is not saying that we're in panic. The 3-month is saying, yeah, for maybe the first, the 9-day couple of weeks time, or it's fearful, but let's look at in the medium term, it should be fine. So the 3-month is actually telling us to calm down a bit. Now, this is, I'm going to take you to a couple of more charts, right? The VIX, what's this? The VIX 9-day against a 3-month. This is something that's interesting as well. So this is a ratio that I've always been looking at, and we are now almost the second highest ratio since basically of all time, since 2015. So if we look at the three ratios, in 2015 we were at 1.66, COVID we were at 1.77, and now again we are at 1.62. So these signals don't often happen a lot in the market. So we are probably, in the last 10 years, this is the third highest, and maybe it'll go a bit higher, that we've been fearful in the markets. Now this has to unwind. This This is not going to stay fearful forever. And each time when this basically came down, we had one of the most steepest rallies ever. You remember COVID, 2015 to 2016, 17, it went up as well. And this is what I see here as well. Once this unwinds and nothing is systematically broken, which is the case right now, this will unwind into a huge. This is the fuel for the melt up, in my opinion. So this is something that's very, very interesting to see how much there's a divergence between the short-term VIX and the long-term or medium-term VIX. And right now we're in the middle of panic. We're in the middle of fear, more than fear, I would say. And the last one I want to show you, which is the volume VIX, the VVIX, is saying right now at 170. COVID, if we go back to COVID, it was 186. Right now, I wouldn't be really doing anything because the market's expecting wild fluctuations. Volatility, it could spike up 4%, go down 2%, go down 5%. It could be all over the place until this starts going below 150, 140. Then you could say the VIX has turned. Once I would say the VIX is below the 3-month VIX, then you can say that things are now easing, and the VIX 9-day comes below the 3-month as well. So these are all signals you can look at to say when the volatility now is basically finished. Right now, I would still say we're in the peak of it, so we have to keep on looking at this. But is something broken in the system? We'll go on to the next chart. Doc will explain in a second, what we're going to go on to. But this is just the volatility. And right now, I say, we're in high volatility, peak volatility. But when this unwinds, watch out.
Yeah, talking about liquidity as in credit, because this is a really important one, and you did mention earlier in the video about copper. So if copper's bouncing and we see like HYG is actually holding above 75%, and the repo markets are calm, so what, why is there a panic? I mean, is this a 2008 rerun or just another macro tantrum that traders are basically taking advantage of?
Yeah, and this is where I want to show you when we come into the credit spreads, and the main ones I track, right? So there's a couple of things I track, and the HYG is the iShares junk bonds basically, and what we want to see, and this is something that's very interesting to see. If I will show you with so what we normally see with this is that once this starts breaking down. So this was 2008. This is when the Fed stepped in, and it was all over. Basically, it was the financial crash. That's when basically the system was broken. Again, COVID, you can say, it went down to about, I think it was 67, 68. And again, earlier this year, we had a couple of bank problems where the Fed had to come in and talk a bit dovish, and it moved it up. This area, this is what people are saying is the top of the market. This is no way the top of the market. This is just the market repositioning itself. Yes, we've come down to 75.4 today. I wouldn't say right now this is alarming. If it comes below 72, 70, around this area, then I would say, okay, there's a big chance of, a bit lower. There's more stress in the market, and the Fed will have to come in. And it could be painful, a bit more painful before we start going up. This is not how a market is euphoric. Now, if we go back to 2008, the market topped when credit was near to all-time highs. 100. Greed, so much greed. Back in if we're looking at crypto, right? Back in 2000 and where do we have it? 21. So 2021. Credit was at 88. Very, very, people were very euphoric. 2017, you're in the 80, 90 time. This was extreme, to 2008. This was extreme before, but since the financial crisis, 88, 90, you're in, people are very happy with credit. There's too much of it. There's too much confidence, basically. This whole cycle from 2022, credit hasn't gone above 80. This is not euphoria. This is not the same structure as 2021. So I know where people like to think it is, and 2021, we've had the macro cycle top. not in terms of euphoria at all. And right now it's just repositioning, and I think this will this will, once this holds and starts reversing, you're going to get, that's when you're going to get the euphoria coupled with the, in my opinion, the VIX, the VIX actually coming down. So this is actually a big setup that's happening right now, in my opinion. Yeah, it might be a bit of pain. Things are, a bit stressful, but at the end of the day, in terms of credit, things are, they're not breaking. And the other chart I want to show you, which is the finance rate, 4.4. Okay, a secured financing rate, 4.4. Fed funds rate, 4.25, 4.5. It's kind of in the middle. There's no stress at the moment in this. This changes basically every day, so there's no stress in the market. The time there was stress in the market, and I'll try to show you it here, was let's go back, was, you can see when stress comes in. So this was 2019. It flipped, about 10% in one night, where there was stress, and then the Fed had to come in and cut rates. Right now, I would say it's not really. If this went above the Fed funds rate at 4.5, so if this flipped to like 5-6% overnight, yeah, there's stress in the market, and the Fed would come in. You probably see another flush in the market, and then things would level out after that. But right now, a lot of fear mongering going on. But until we see credit, and liquidity actually break, it's just volatility. It's just a lot of volatility at the moment, in my opinion. So yeah, that's what I have for that.
Now, viewers, before we get into the two paths ahead of us, or what we could see, jump into the bigger picture, and we want to give you a quick quick heads up. We're putting out a lot of free content right now, breaking down macro concepts that actually matter. These are free, straight up guides to help you make sense of what's been happening in the macro and what is exactly behind the headlines. And you'll find this all under our website, themarketsunplugged.com, under the crypto economic section. It's going to be updated daily or every other day, so you find it useful. And if you find our videos useful, as earlier, like our video, subscribe to the channel so you don't miss out on any content. Now, Oz, looking at the bigger picture, what's happening next? Because is this the start of a breakdown or the reset before the breakout? Because if volatility does get crushed and positioning does reset and the credit holds, are we actually looking at the beginning of the next leg up when it comes to the crypto markets or the markets in general?
Yeah, personally, if credit doesn't break, for me, if the financing rate stays where it is, kind of how it is, CPI coming down, inflation coming down, tomorrow's inflation print, I'm sure it's going to be quite a downside surprise, in my opinion, right? Credit, HYG, there's other ones you can track, with junk bonds and other sort of credit spreads you can track. If this doesn't break, and what I think this is just overblown fear, right? What you're going to get is this whole fear cycle basically unwind, and that's going to create one of the biggest melt up since COVID, because this is almost near the higher the peak of the fear, that's how high, high the rebound is. Think of it like an elastic band. This is being basically squeezed, as far as possible, and now it's going to snap. Now, as what we want, obviously what we want is for nothing to break, for credit not to break, for liquidity not to break. And right now, I can't see that happening. And even with repo, I can't. There's nothing majorly out of the ordinary that's happening in terms of, there's no spikes in repo or anything like that. So, these are the main things I'm tracking. And then what normally happens, volatility won't stay this high, for that long. This is, things will sort themselves out. You're not going to get the VIX 9-day, at 70, 80 for the next 2-3 months. This will blow over in about a week or two. And if this blows over in a week or two without any kind of systematic crash, all I will say to you is watch out, because this will start going. Now, if we do have a systematic crash and we have credits, drying out, or liquidity drying out, and the Fed coming in and having to fix it, it's not going to be great. Probably get another flush, to be honest, and then we'll start going up. So they're the two options. But this fear will be basically going all the way down, and this unwinding of fear is going to be crazy. That's all I have to say. But let's look forward to that. in the future. But right now, it's just it's a crazy market.
There you go, viewers. Thanks for joining us. Everybody sees panic, but under the surface, the structure is still holding. And when the volume fails, the chase could actually begin. So this might not be the end. It just might be the craziest reversal of all time and the start of a launch pad. Again, viewers, thank you for joining us. Hit that subscribe button if you haven't. Hit that like button. Drop your comments below and see you guys in the next video.